We all want some level of safety and security. Firefighters, construction workers, EMT. They're all there when you need them to help manage life's chaos. In retirement, you want that same level of safety, but who is there for you to make sure your money will last? Brian isn't just there in case of emergency. He's there so you don't have an emergency with your money. A safer retirement doesn't mean a boring retirement, but a prepared one, full of the things that inspire you. This is Safer Retirement Radio with Brian J. Decker.
Welcome into Safer Retirement Radio with Brian J. Decker of Decker Retirement Planning. I'm Mark Elliott. Glad you are with us today. We're going to talk. Brian and Marc Knauss are here. Mark and Brian certainly with DeckerRetirementPlanning.com. You can always go to that website, DeckerRetirementPlanning.com, to learn more about what they can do for you. It's really a full retirement planning process, a safer retirement process. Income, investment, taxes, healthcare, legacy planning, Social Security is in the income part, healthcare is in the Medicare is in the healthcare part. A lot of moving pieces. So that's where Brian and the team and Mark and the team at Decker Retirement are here to help you figure out where you are, really to give you some clarity into your situation. You can always go to the website. I tell you this every week on the program, DeckerRetirementPlanning.com. There are 12 different things you can download under the heading of Safer Retirement Education, including Brian's book on retirement, the Decker Approach book. But it's all there, no cost to you. It's just there for your information. Download any or all. It's up to you. But that information is there for you to learn a little bit more about retirement. If you have questions, maybe you're getting closer to retirement. You're trying to figure out, I think we're going to be okay, but I don't really know. What a great time to call the team. 833-707-3030. There's no cost to you whatsoever, no obligation, no pressure. 833-707-3030. I'm Mark Elliott. Brian J. and Mark are going to take it from here. Brian, go ahead.
All right. We're going to talk about risk in retirement. And Mark, before we talk specifics, I want to get big picture. When people are in their 20s, 30s, 40s, 50s, the risk exposure is different. So markets can drop 30, 40, 50%. No big deal. Your 401k is down. You have the time, the 3 to 5 years for the markets to recover, and your income's coming from work, so no big deal. And every 2 weeks, you're contributing more money to your 401k, so you're dollar cost averaging into a down market. So when the markets recover, you're the better for it. You've actually benefited from that experience. Now contrast that with being 65 plus years old, you're in retirement. Now your portfolio isn't being contributed into, it is being drawn out of. So now you drop that portfolio 30, 40, 50%, and you're drawing money out of it. That is a totally different story. So right up front, want to make the point to our radio listeners that accumulation strategies are what get you to retirement, and bankers and brokers are very good at it. But distribution strategies are what we use in retirement. So for example, Mark, I use this silly, stupid example, but I had a knee replacement done 4 years ago. I didn't go to a dentist. Dentists are good people. They're good, hardworking, ethical, moral, wonderful people, but they didn't do what I needed them to do. So we specialize in retirement planning and using distribution strategies. And in today's radio show, we're going to flesh out some major differences between accumulation and distribution strategies. But let's still stay big picture, Mark. Let's say that you retire with $1 million January 1 of 2000 versus me retiring January 1 of 2003. You retire right in front of a 50% drop in the S&P 500. I retire right in the bottom of that mark. There's something sequence of return risk. Mark, can you flesh that out and talk to our radio listeners about one of the risks is sequence of return risk, the timing of your retirement?
You're absolutely right, Ryan. And just being a financial advisor for 13 years, I've run into this so often over my career is when you get into retirement, it's a different state of mind. It's a different strategy that applies. So let's say, for example, you retired, like you mentioned, $1 million in 2000, and right before the stock market crashes. Now, all of a sudden, your stock portfolio is down 50%. a very common rule of thumb distribution rate out there in the industry is something called the 4%. This is probably the most toxic distribution strategy out there because I think it's lazy. I think it's not well thought out. It's just a rule of thumb for the DIYers and the financial planners out there that don't do distribution planning. So play the math out with me. Let's say you retire 2000 and over the next 2 years, the stock market is down 50%.
Mark, before you play this out, which is going to be very interesting, I want to give the big picture to our listeners. The 4% rule has the background of people observing that stocks have averaged around 8 or 9% for the last 100 years. Bonds have averaged around 4.5%. So why not just draw 4% from your portfolio for the rest of your life, and that should be fine? Well, markets cycle. They don't trend, they cycle. Markets don't go up, they cycle. So for example, and this is something that we'll talk about later, but I want to bring this up specifically for the 4% rule. There's been 4 times that the S&P 500 has traded above a market valuation of 30 times trailing earnings, only 4 times. One was 1929, and markets were flat for 17 years. Then in 1964, we hit that valuation. Markets were flat for 18 years. Then in November of 1999, we hit that market valuation. Markets were flat for 14 years. Well, we hit that again in November of 2021. So the 4% rule, Mark, that you're going to talk about ties in sequence of returns, but it also has to do with a flat market cycle. When you're in an uptrending market, the 4% rule works perfectly. But when you're in a flat market cycle like we believe we're in now, not only doesn't it work, but you're going to demonstrate mathematically how it destroys your retirement. So Mark, back to you.
Yeah, thank you, Brian. So the 4% rule as a distribution strategy, let's say you've got $1 million and you want to only take 4% from the portfolio every year, $40,000 from the portfolio. Now the stock market's in a down cycle. It crashes 50% in the dot-com bubble. Well, you're taking $40,000 a year out of that portfolio. So you're not down 50%. Now you're down 58, 62% because the market's down. Then the market recovers. Oh, awesome. The market's recovering. But you're still taking that $40,000 a year out of the portfolio as retirement income. So you're taking 4 and 4 and 4 and 4. The market's up 100% off the bottom, but you're only up 80%. Then the market crashes again. And now you've got the housing bubble crash. The market's down another 50%. And you're taking 4%, $40,000 a year from the portfolio. Now your distributions are absolutely way out of kilter from that 4% rule. And then the market recovers. And over time, the Wall Street has a 0% growth rate from 2000 to 2013, no growth, but you're actually down about 30% because what we found in a flat market cycle is that distributions from the portfolio in a fluctuating account accelerate the downside and compromise the upside. So you're getting more of the downside risk and you're getting less of the upside growth when you're taking money out of a fluctuating account.
And
So
Mark, millions of people just cashed it in 2009. They just went back to work. Millions of people showed up at banks, fast food, Walmart, because they had to. The 4% rule actually destroyed their retirement. They had to go back to work because they hadn't made any money for all those years, over 8 years, plus they were drawing 4, 4, and 4. Well, 4 times 8 is over 32%. So that combination really hurt millions of people in retirement. And the guy who invented the 4% rule, William Bengen, he actually came out and said that the 4% rule does not work in a flat market cycle. Well, we believe that we've entered another flat market cycle. So we want to do our radio audience a favor doing a community service here and warn you that in a flat market cycle, the 4% rule does not work. Now, Mark, we're going to get to what does work, but we've talked about sequence of return risk and distribution risk with the 4% rule. Now let's hit, if we can, the three major ways that we at Decker Retirement, how we minimize risk. So this is quantitatively, strategically, and also eliminating interest rate risk. Why don't you start with that one, eliminating interest rate risk, because those other two are going to probably take 20 minutes.
Sure. So when we talk about interest rate, and when your financial advisors talk to you about interest rate risk, what they're doing is they're talking to you about the investments that you have and the exposure that they have to fluctuating interest rates. So if interest rates go up, typically that's going to be bad for a bond fund. If you have bond funds in your portfolio and we're in a rising interest rate environment, well, that means that the value of your bond funds are going to lose money. So that means that you have what's called interest rate risk in your portfolio. We see that as a very dangerous thing because right now, historically, interest rates are on the low end and they could be rising. We could be in a rising interest rate environment. So as you go into retirement, if you've got half of your portfolio or 2/3 of your portfolio in what your advisor is telling you is very safe, very secure investments in bonds, well, guess what? Those bonds are subject to interest rate risk, and those bonds can and will lose money in a rising interest rate environment. We never want to put our clients at risk of a rising interest rate environment where they have interest rate risk in their portfolio.
Okay, now interest rate risk, it's to go along with interest rate risk. Let's go back to 1940. In 1940, the 10-year Treasury was at 2%. In 40 years, it went up from 2% to, in 1980, it was at almost 15% on the 10-year Treasury. Then for 40 years, interest rates declined. From 1980 to 2020, interest rates declined to where they bottomed around 0.47% in August of 2020. At that point, when we're at 0.47, any financial advisor recommending bonds and telling you that's where your safe money is, that's financial malpractice in our opinion.
Brian, we saw this significantly in 2022 where we saw interest rates skyrocket. We went from 0.47 up to about 4% in a matter of about 12 months.
And by the way, that's about a 35% loss of principal in those 3.5, 4 years for people's, quote, safe money. People lost a lot of money in bond funds since August of 2020. Now, I want to also talk about the Fed lowering rates and talking about lowering rates since September of 2024.
All right, so we're going to do that in the next segment. We're getting into lowering interest rates. How does that affect you? Because our overall theme today is risk reduction. How do you invest without losing sleep? That's kind of a good topic, and that's what we're talking about today. Brian and Mark talking about all of that. We'll get into lower interest rates when we come back. But again, if you'd like to sit down with the team at Decker Retirement Planning and talk about some of the questions or concerns you have, maybe it's this exact topic, 833-707-3030. Again, no cost to you, no pressure whatsoever, no obligation. It's just an opportunity for you to get some clarity into your situation, get some of your questions answered, some concerns answered. 833-707-3030. Back with more with Brian J. Decker and Marc Knauss of Decker Retirement Planning right after this.
Is the price tag on everything giving you sticker shock? From groceries to gas, the cost of living is skyrocketing. But if you think inflation is painful now, just wait till you retire. Ease inflation's impact on your retirement dreams by calling Brian and start preparing today. 833-707-3030. Again, that's 833-707-3030.
Uncle Sam might need a loan soon from you. We have over $35 trillion in national debt. Where do you think the money to pay for that is going to come from? Taxes. Believe it or not, taxes are at historic lows right now. But how much longer will that last? A Roth IRA conversion might be a good option when planning for your retirement because you can pay lower taxes now and avoid potentially higher taxes later on. Brian Decker and the team at Decker Retirement Planning have seen taxes rise and fall. They know what options you have to potentially reduce the amount of taxes you pay in retirement. Call the team at Decker Retirement Planning and schedule your tax analysis today. 833-707-3030. That's 833-707-3030. Uncle Sam needs money. Don't let him take it from you. 833-707-3030. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor. Investing involves risk. Always consult with a qualified tax advisor before making any decisions regarding a Roth IRA conversion, as there may be additional tax considerations.
You're listening to Safer Retirement Radio. If you like what you hear on today's show or have questions, drop by DeckerRetirementPlanning.com or call 833-707-3030 to talk to Brian.
Welcome back to Safer Retirement Radio with Brian J. Decker and Marc Knauss of Decker Retirement Planning. You can always go to the website to learn more, DeckerRetirementPlanning.com. I'm Mark Elliott. You can always call the team if you have questions, 833-707-3030. No cost for this conversation, 833-707. We're talking about risk reduction, how to invest without losing sleep. That's kind of a big topic. And Brian, you were getting ready to, you talked about rising interest rate environment. Now you're going to get into the lowering interest rate environment, right?
Right. The Fed talked about lowering rates and has lowered rates on their overnight lending rate. They have control of the overnight lending rate, the bank lending rate, but the open market rate they don't have control of. That is the open market rate where the 10-year treasury, 5-year treasury yield, 30-year treasury yield, the open market bond rate is what they don't have control over. It's interesting that right now, with Mark, the Federal Reserve lowering the rate that they have control over, that the open market rate has gone higher. The 10-year treasury yield in September of 2024 was at 4.1%. Right now, it's at 4.8%. So now we have rising interest rates with the Fed lowering rates. The reason is because the bond auctions that are being held to move this massive amount of debt that we have as a country, 37 trillion in debt as a country. We are having trouble moving that amount of that volume of debt at these bond auctions. And so when an auction fails, that means that they have to raise rates to entice people. This is supply and demand, Econ 101. They have to raise rates to entice more people to place money and lock it up for 3 months, 6 months, 9 months, 1 year, 5 year, 10 years, 20 years, 30 years, whatever. Those bond auctions have not gone well, requiring a higher rate to move that money. So in the open markets, rates have gone higher. People have been losing money in their bond funds as interest rates have gone higher for the last 4.5 years. So, Mark, when a banker or broker or advisor tells you that you put your safe money in bond funds, that is by habit. It is not by looking at the markets and seeing that we entered a rising interest rate environment in 4.5 years ago in 2020.
Yeah. What I like to make the example of with our profession is, like, say you're a general contractor and you're hired to do a job, and the only tools that you have at your disposal are a hammer and a screwdriver. Well, you're probably not going to be very successful if you don't have the right tools for the right job. So that's part of our strategy here at Decker, is to apply the right tools to the right job to protect our clients from strategies, just like you're mentioning, Brian, a rising interest rate environment or a falling interest rate environment. How do we reduce the risk in your portfolio from these unknowns, right? Where our clients don't have to worry about what the Federal Reserve is doing and what the bond auction is doing. How can they navigate retirement comfortably despite what is happening on Wall Street?
Okay, Mark, so let's talk about the other ways that we lower risk. We talked about eliminating interest rate risk. Hopefully, people in their retirement portfolios will have zero bond fund exposure. So now let's talk about the other ways that we lower risk. One is quantitatively lowering risk, and the other is strategic. And I know that's probably 15 minutes worth of content right there. So, Mark, off you go.
Yeah. So let me talk on quantitatively first. When you retire and you are now distributing income to yourself, your portfolio turns into a paycheck. You need to start drawing down your portfolio. Well, we talked about the dangers of sequence of return risk in your portfolio and drawing income from a fluctuating account. Instead, If you use principal guaranteed accounts that have no stock market exposure to them, you're able to draw your portfolio from accounts that have no downside risk. So quantitatively, what you're looking at, the percentage of your portfolio that has no downside risk, you want that number to be somewhere in the neighborhood of 60 to 70, 75% of your portfolio having no downside risk. So quantitatively, your reduction of risk is significantly smaller than what it is in your accumulation years. In the accumulation years, risk is your friend. If the stock market goes down, you just put more dollars into your portfolio. You don't have that option when you're drawing income from your portfolio. But you need to significantly reduce your stock market exposure in retirement because now that's your paycheck. So quantitatively reducing your risk to the stock market is very important. And you're also able to do it strategically. So in the Navy, we said tactically. How do you go about and look at each individual investment strategy that you have, and how do you minimize the risk that the stock market might offer, both in your principal guaranteed accounts, but also in your risk accounts, in your brokerage accounts? How are you reducing stock market risk in those accounts? Because the purpose of those accounts is that long-term growth. If the stock market crashes, you don't want to take that crash. You want to be able to sail through that type of a market environment. So we're looking at overall portfolio risk reduction.
Now, again, most people, bankers and brokers, are recommending people have 60-40 or 70-30 portfolios. Now, that is insane to us at Decker Retirement. We are specialists in retirement planning. And for people in their 60s, 70s, 80s to have 60 or 70% exposure to the stock market is much higher risk than we would recommend. We recommend that clients have about 25% of their portfolio at risk. We're talking about historically with 100 years of experience with this working for the past 100 years. We're talking about all passive investment strategies, buying and holding stocks, mutual funds, indexes, and ETFs will yield a zero return on 60 or 70% of client portfolios. That is devastating for people in retirement. So quantitatively, we want to dramatically lower that risk to about 25%. So Mark, I interrupted you. So jump into the strategic side and talk about in detail how in a flat market cycle, the strategies we have used allow us to make money in up markets and allow us and are designed to make money in down markets as well.
Well, you had mentioned that when the market is trading at, we see it as astronomical price to earnings ratio. You look at the trailing PE ratio right now, and it is at all-time highs. Typically, historically, when we get to this point, the market can go into a flat market cycle for 10, 15, 20 years. And if that's the case, if you go into a long flat market cycle, and your financial advisor is telling you, oh yeah, we can anticipate about 6% rate of return for the next 20, 30 years, and you get zero for 10, 15 years of that, but it blows up your plan. So you fold into your plan what's called an actively managed strategy called momentum strategies. A momentum strategy is an active managed strategy that allows you to take advantage of both upside market cycles and downside market cycles. So you can make money when the market is going up, but also when the market is going down, which allows you to weather the storms in that risk bucket part of your portfolio. So let me give you an example of how momentum strategies work.
And Mark, before you get into the details of that, I want to still stay big picture. The reason we came to momentum strategies is we are fiduciaries to our clients. We're a math-based firm. We take that responsibility seriously. So we've done the homework. We've gone back and looked at the biggest databases in the world. On a quarterly basis, we look at the Wilshire database, largest database of money managers in the world, the Morningstar database, largest database of mutual funds in the world, and 3 others. And we want to know what has produced the highest returns in over a long period of time. Since 1950, the biggest study ever done on this was by Jake O'Shaughnessy in his book, What Works on Wall Street, Appendix A, page 367. He outlines what has produced the highest returns, and not just the top 1, 2, or 3. The top 15 or so are producing the highest returns. They are momentum, relative strength, and sector rotation. Those 3 strategies are the same. So radio listeners, try to imagine every stock ranked 0 to 100 based on relative strength, which is a function of price appreciation and volume. Momentum has you buying those top relative strength stocks. When something better comes along, you rotate into it. It is sector rotation, it is momentum, and it is relative strength. And so that strategy allows you to cherry pick the best parts of the market when the market is trending higher. And then when the markets get creamed, it goes and rotates into whatever is going up. So for example,
I'm going to cut you off right there, Brian. We'll get back to that at the start of the next segment. We're running out of time right now. But again, if you'd like to learn how this momentum strategies might play out for you, you never really heard of them, would like to learn more, it's 833-707-3030. Brian J. Decker and Marc Knauss back with more of Safer Retirement Radio right after this.
Your story is unique, and so is the legacy you leave behind. Connect with Brian Decker at 833-707-3030 to start writing the chapters of your legacy and ensure it reflects your values and dreams.
When you crash your car, you get it fixed. When your computer crashes, you get a new one. But what will you do if you've been saving in a 401k or an IRA and the market crashes? If you're in your 30s or 40s, you'll likely be just fine. But if you're in or near retirement, you could be in trouble. Brian Decker and his team at Decker Retirement Planning are here to help. They can run a risk analysis to see if you're too heavily invested in the market. Are you confident that a Wall Street crash won't wreck your retirement? If not, call 833-707-3030 today to schedule your risk analysis with Brian Decker and the team at Decker Retirement Planning. That's 833-707-3030. Crashes happen. Question is your retirement ready? Decker Retirement Planning, 833-707-3030. Investing involves risk, including the potential loss of principal. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor.
Glad you're with us today for Safer Retirement Radio with Brian J. Decker and Marc Knauss of Decker Retirement Planning. You can always find out more on the website, deckerretirementplanning.com. I'm Mark Elliott. Again, the number, if you'd like to just have a conversation. I got some concerns. I got some questions. 833-707-3030. There's no cost, no obligation, no pressure whatsoever. 833-707-3030. Might be the most important phone call you make. Certainly today, to get some clarity into your retirement picture, 833-707-3030. All right, Brian, I rudely interrupted you at the end of the last segment. Now you may continue.
Okay, we're talking about risk reduction, and Marc Knauss out of Bellevue office that we have, Bellevue, Washington, he was talking about the 3 ways that we lower retirement planning risk for our clients. One is we eliminate interest rate risk because we have no bond fund exposure. Bond funds lose money as interest rates go higher. Since in the last 4.5 years, bond funds have lost over 35%, and bankers and brokers have told you to put money there and called it your safe money. Well, bond funds lose money when interest rates go higher. That's interest rate risk. We do not use bond funds in our client portfolio, so we eliminate interest rate risk, number one. Number two is we quantitatively lower risk. Mark talked about how instead of a 60-40 or 70-30 portfolio with 60 or 70% of your portfolio at risk, which we think is crazy, we lower that exposure from 60 or 70% down to about 25%. So we quantitatively lower your risk. Now, the third thing is strategically we lower your risk. So we're talking about momentum strategies, why we use momentum strategies. We talked about the indexes that we look at showing, and the studies done since 1950 showing that momentum strategies have produced the highest returns, and wanted to give specific examples of 2000, 01, and 02. In those 3 years, the S&P is down 50%, NASDAQ's down 70%, and yet many sectors of the market were going higher. Those were real estate through the REITs, gold, silver, energy, pharmaceuticals, biotech, and healthcare made double-digit returns each year for 3 years. And then the markets bottomed in March of 2003. And what exploded to the upside for 4.5 years was technology, semiconductors, small caps, and emerging markets. They made a lot of money. Then rotating into 2008, that was a waterfall decline. The way momentum strategies protect your capital, if nothing is going higher, you are stopped into cash, with the exception that year of treasury bonds. Treasury bonds were up 22%. So this is a way for us to protect client portfolio by being in the best sectors of the markets when the markets are trending higher. And then when the markets are trending lower, we have an offense defensive strategies where when the markets are trending higher, trending above its 200-day moving average, which by definition is where the markets are in an uptrend, we have an offensive team on the field designed to cherry pick the best parts of the market and make money in an up market. Well, when the markets cross and start in a downtrend, trading below the 200-day moving average of the S&P 500, we have the defensive team on the field. These are 5 different strategies that historically have done very well. They made money in 2008, in 2015, 2018, and 2022. All those were big down markets that have hurt people in retirement, and these strategies are able to make money, designed to make money in down markets. So in the recent drop that we had, Mark, in 2022, the S&P was down 19%, bonds were down 20%, NASDAQ was down 33%, everything was down with the exception of energy. Russia had invaded Ukraine, and so energy was going higher. Momentum strategies had you in the frackers and the drillers and the natural gas and crude oil companies and the pipelines. They made 15 to 20% when that year most people lost 30. So that's another way that we protect client portfolios by strategically lowering their risk.
You can see when you're working with a financial advisor and you're talking about investment strategies in distribution, in your distribution years, in the years where your portfolio is becoming your paycheck, it's a totally different conversation than the conversation around keep your costs low, just buy and hold the market. If the market crashes, keep your head down, just keep putting new dollars in. That's an accumulation mindset, and that's appropriate for people who are building their portfolio. But in the distribution years, it's a totally different conversation. And you need to be working with a financial planner that specializes in this. You need to work with a financial advisor that is seeking to reduce your risk in your portfolio, looking to fold in strategies that are specifically tailored to people in retirement as a distribution.
Now, Mark, we talked about not using bond funds. So what do we do? Stay high level and talk about the buckets 1, 2, 3, 4, and 5 that we have that are principal guaranteed, kind of give an overall description of them, and then the 4 key reasons we use them like we do.
Right. So a very effective strategy for distribution strategies is something called a bucket strategy. A bucket strategy is designed to identify dollars that are going to be used for short-term money, medium-term money, and long-term money. And you give those buckets a different name, a different purpose, and a different risk tolerance because you're going to need those dollars at different time horizons in your account. So we use principal guaranteed accounts as our risk buckets. These principal guaranteed accounts have no downside risk in the portfolio. So going into retirement, your money is safe, your money is secure, and it's treated with a purpose for different time horizons. So Brian, you mentioned bucket one. Bucket one is going to be the first bucket that you draw income from in retirement. Its job is not to be a long-term growth strategy that's invested in the stock market. Its job is to be liquid and stable because you're going to need that money in the short term. Typically, we use something like a money market account. We use high yield savings accounts, something that currently money markets and high yield savings accounts are generating about a 4% yield on them, and they're fully liquid and they're principal guaranteed. That's a great solution for your short-term money. Think 1 to 3 years. That gives buckets 2, 3, 4, and your other buckets room to grow. So it allows them to take on a little bit more risk and get a little bit more growth while you're drawing down your lower growth account first. Buckets 2 and 3, typically these are 3 and 5 year strategies. So now you've drawn down bucket 1 and you need to start pulling money from bucket 2 and bucket 3. Typically we'll use something like CDs in these accounts. These are fixed rate strategies, maybe not so liquid. They're not as liquid as a money market, but they're guaranteed to grow at a stated rate. Right now, we're seeing rates in the neighborhood of 5 to 5.5% in these buckets. And their job is to generate income in the medium term. So you don't need that money now, so let them grow and take advantage of compound interest over a medium-term time horizon. Then you get out to your longer-term strategies.
Before you get into 7 and 10 year rates on those longer term strategies, those first 3 buckets are fixed rate accounts. So no matter what the markets do, you have that as a known, that money is going to be coming in and that rate is fixed. So Mark, go ahead with the 7 and 10 year rates.
Yeah. So as you get out further in time, now you start taking on additional risk. Now your risk profile can increase a little bit to get a little bit more growth. So what we're seeing in buckets 4 and 5 in our longer term strategies is very good growth rates. We're talking high single, low double digit growth. Typically, these perform at 2 to 3 times the CD rates.
You're not taking more risk on because these are principal guaranteed accounts. You're going out farther and getting a higher return.
Right. So your time horizon allows you to get a higher rate of return in these. So these are excellent strategies for medium to long-term holds in your portfolio. Money that's designed for 7 years to maybe 12 years. That's the time horizon where these really work. And then you have your brokerage account, your risk bucket. And the risk bucket, you're able to take on a more aggressive stance. So that's where your stock portfolio is. And the purpose of the risk bucket is later on, you'll use the risk bucket to replenish the income buckets as you spend those down. So Brian, you had mentioned the 4 key points of why we use strategies like principal guaranteed buckets and the risk bucket. The first one, I tell you, just the peace of mind that clients have. When I have annual reviews with clients and they're in this process and their income is coming from these principal guaranteed accounts, they are so grateful and so happy with how the plan works and the peace of mind that they have regarding their portfolio. So that's key point number 1. The second one I mentioned is that by doing a laddering strategy, you have your short-term bucket, your medium-term bucket, your long-term bucket. It allows you to take advantage of compound interest. More dollars are pushed to the back of the plan, and those are higher growth dollars. So while you're drawing down income from your short-term and medium-term buckets, your long-term bucket has room to grow. The third key point is that risk bucket. The risk bucket, it starts out at about 25% of your overall portfolio, but its job is to grow at S&P 500-like returns or better. We're not doing a pie chart. We're not doing 60% bonds, 40% stocks in that. We want that to grow at a high growth rate for as long as possible because that's the growth component in the portfolio. So you want long-term high growth in that risk bucket. Typically, we're seeing S&P 500-like returns there. That's the job. But specifically, Brian had mentioned the momentum strategy. We run that strategy in the risk bucket for that long-term growth. The last piece, and this is just our way of hedging our bets, is we show extremely ultra-conservative growth rates in our planning process. We downplay the growth factors in our planning process because we want to be ultra confident in the income that the portfolio can and will generate to you for the rest of your life. For the rest of your life, your portfolio is generating income. And if we exaggerate the growth numbers, then we're doing you a disservice. So we want to be incredibly conservative with our estimated growth rates in our buckets so that we can be very confident in the income that we're generating to you for the rest of your life.
If you'd like to know more about how this really impacts you and your retirement, you want to learn more how to set this up for yourself. Maybe you like the idea of this, or maybe you want to learn more about it. We'll call the team at Decker Retirement Planning. There's no cost, 833-707-3030. No cost, no obligation, no pressure, no judgment either. We've all made mistakes from time to time. 833-707-3030, because that's the idea. That's why Brian and Mark do this show. And Brian does it every week. Mark does it every once in a while. But they're really here to help you figure out where you are. How can they help you? Can they help you? They don't know. Maybe they can't. But they probably can certainly give you clarity into your situation. Again, that's 833-707-3030. A great opportunity for you to learn more about how all of this could impact you and your retirement. 833-707-3030. Back with our final segment of Safer Retirement Radio with Brian J. Decker and Marc Knauss of Decker Retirement Planning right after this.
Uncertainty in the markets doesn't have to mean uncertainty in your financial future. With the right approach, volatility can be an opportunity. Let Brian Decker and the team at Decker Retirement Planning help you navigate market changes. Call 833-707-3030 today.
Do you want your retirement to be affected by who is in the White House? I didn't think so, but here's the thing. No matter who wins this time, they'll only be in the Oval Office for 4 years. But how long will your retirement last? Presidents can have a huge impact on taxes and the economy, but there is another presidential election in 4 years, then another, and of course another. Brian Decker at Decker Retirement Planning can help you create a customized plan that's really as White House proof as possible. Schedule your visit with Brian Decker today by calling 833-707-3030. Brian doesn't know who will win in November, but he can help you prepare for it, no matter what happens. Reach out to Brian Decker to get started. Call 833-707-3030. Don't let who's in the White House affect your retirement. Call 833-707-3030. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor.
You're listening to Safer Retirement Radio. If you like what you hear on today's show or have questions, drop by DeckerRetirementPlanning.com or call 833-707-3030 to talk to Brian.
Welcome back to Safer Retirement Radio with Brian J. Decker and Marc Knauss of Decker Retirement Planning. I'm Mark Elliott. Just a reminder for those of you that are listening in the Seattle area or you're listening in the Salt Lake City area that the Decker Retirement Planning team has live events typically once a month. You can always go to the website. You've heard Brian and Mark on the radio, and now you're like, well, I want to maybe sit down and listen to them in person, get a little better feel for them with my eyeballs. You certainly can do that. Just go to the website, DeckerRetirementPlanning.com. There's a section for the events that they have. You can check that out. Typically, there's no cost to attend, but some of them do. So there you go. Just check it out on the website, deckerretirementplanning.com. And of course, under the heading of Safer Retirement Education, you've got the 12 different things you could download, a checklist, a toolkit, Brian's book on retirement, the Decker Approach book. But it's really all there for you and your information. Take any, all, download whatever you'd like. Again, that's deckerretirementplanning.com under the heading of Safer Retirement Education. All right. Again, if you have questions, you can always call them 833-707-3030. All right, Brian, you and Mark have been talking about risk reduction, how to invest without losing sleep. Where are you going in our final segment?
Okay, we're going to talk about how we are true fiduciaries and we have an obligation to seek out the best investments that we can find and how we do that. So we use the Wink database that allows us to see banks and insurance companies what the highest returns are for cash, 1 to 3 year, 3 to 5, 5 to 7, and 7 to 10 year principal guaranteed accounts. So by using the Wink database, Mark, we're able to find the highest returns. And then we also talked about in the last segment how on a quarterly basis, we use 5 different databases to find highest earning risk strategies out there. Mark, how would you feel if I was your planner, your retirement planner, and I told you, well, Mark, here's 4 or 5 mutual funds. They're not the best, but these will do. Let's just use these. How would you respond to that?
The good enough strategies, we run into this with a lot of firms out there are not independent firms. So what we mean by independent is they're kind of beholden to their parent firm to sell their mutual funds. So think Vanguard, Schwab, Merrill Lynch, Fidelity. If you go to an advisor that generates their own mutual funds and you ask them to put together a portfolio for you, that's exactly what's going to happen, Brian. They're going to put you into their own firm's mutual funds because that's kind of what they're incentivized to do. And that's what their parent firm has instructed them to do. So you want to make sure that you're working with a fiduciary advisor who has access to everything out there, right? Maybe those are the best funds to invest in, but maybe not. And you wouldn't know that if you're not working with a fiduciary that has access to these databases, that goes and looks for the best risk reward strategies out there, the highest growth strategies out there. Maybe there's other investment strategies that are appropriate for you that those firms don't have access to. So the good enough strategy, I think, is not acting in your fiduciary capacity.
Okay, now when it comes to risk, another risk is how big of a chunk will Uncle Sam take of your money? Mark, talk about, we won't have time to cover all of them. We're very comprehensive in tax strategies that we have, but talk about the biggies, ones that are most widely used by people. Talk about and go into detail. Do you remember that breakout side by side on the Roth version? Talk about that, and then talk about placement, how we make room for Roth conversion. So that will take some time right there.
Now, real quick, we are adamant about minimizing taxes to our clients in their portfolio, income taxes, capital gains taxes, estate taxes, any tax that we can find, we can minimize. We want to take advantage of that. For most of our clients, the vast majority of our clients, the most taxes that they'll pay over their retirement period is coming to them from their IRAs, from their pre-tax accounts. So the Roth IRA conversion is probably the most powerful tax saving strategies that we have at our disposal for most of our clients that are in this situation. So every year we want to be having the conversation around Roth conversions, and we utilize a strategy called bracketing. When you're talking about how much of a Roth conversion you should do, well, you want to be very precise with your numbers. You don't want to convert your entire portfolio from pre-tax to Roth because you're going to overpay in taxes. So we know to the penny how much Roth dollars you should have in your plan and in your portfolio, because before we even have the conversation, we build out your income plan. So you can't do these tax strategies based on a pie chart, based on just kind of putting your finger in the air and seeing which way the wind is blowing and seeing, well, maybe I should do a Roth conversion this year. I don't know how much, but we'll just do some. By having a plan in place, now all of a sudden we know exactly how much Roth you should have in your portfolio, and we do it incrementally over the years so that by the time we need that money in your portfolio, it is 100% tax-free. Long term, that will save you, they could save you 6 digits in total taxes paid over your lifetime. Very powerful tax planning strategy. And then the second one that Brian mentioned is something called placement. Again, you have to have a plan in place in order to implement these tax strategies. So the plan is foundational, and then you build the tax strategies on top of the plan. The way placement works is going back to the bucket strategies. If we know what dollars are going to be distributed in years 1 through 3, 4, and 5 in your plan, the early years in your plan, well, we can send money to you from your non-qualified accounts, your non-retirement accounts. What that does is it drives your adjusted gross income way down. The income that you report to the IRS is now very low because you're taking money out of savings accounts, money market accounts, your bank account, your joint investment account. Very low tax implications on those distributions. And that gives us the opportunity for your long-term money to do those Roth conversions. You take your pre-tax IRA and you convert a portion of that to your Roth in the early years. So now your Roth IRA has years to grow at the highest growth rate possible in your plan. So that we call that placement. And what you're looking for is short-term distributions coming from non-retirement accounts, giving you the opportunity to do Roth conversions in your long-term accounts.
So, Mark, I'm going to say that differently. When you pull money out of non-qualified accounts, that would be an example like pulling money out of savings or checking. You're not taxed on that at all. When you pull money out of IRA accounts, you're taxed on that income. So what we do is if clients have an even mixture of qualified and non-qualified money, we sprinkle that non-qualified money in the front part of the plan in the first 10 years. So yeah, they may be getting 80 or 100,000 of income from their portfolio, but the taxes they owe on those funds is tiny, tiny small, allowing us in those early years to do Roth conversions where we pay the tax now, so all that growth is tax-free. Now, Mark, you've got a side-by-side comparison to drill the point home about how important the Roth conversion is. The 60-year-old that has $1 million IRA growing at 6% a year. Go through those numbers for our radio audience.
Right. So walk with me real quick as I show you two different scenarios. The first scenario, 60-year-old client with $1 million portfolio. This is in her IRA. So this is growing at 6% a year, tax deferred. So you're deferring growth, deferring growth, deferring growth. Now all of a sudden you're 73.
Deferring taxes.
Deferring taxes, yes. So now all of a sudden you're RMD age. You have to start taking money out of that pre-tax account, and all of that growth has been deferred. All of those taxes have been deferred, and you have to start taking your required minimum distribution. So over the course of this client's life, we show her living till 90 years old. She pays a total of $676,000 in taxes to Uncle Sam. But wait, now she passes away, and because of the Secure Act, her children inherit the IRA, and over the next 10 years, her children have to distribute that portfolio. They pay $718,000 between the client and her children. They pay $1.4 million in taxes to Uncle Sam, and they're left with $1.2 million net after tax. $1.2 million on a $1 million IRA. This should infuriate everybody out there who sees these numbers. $1 million IRA growing at 6% a year for 30 years, net benefit to the kids, $1.2 million after tax.
If you'd like to sit down with the team at Decker Retirement Planning to talk more about this and everything else that Brian and Mark have discussed today on the program, there's no cost to you. It's 833-707-3030. Again, 833-707-3030. You can always check out the website, DeckerRetirementPlanning.com. Find out about the live events that they put on in Seattle and the Salt Lake City areas, usually once a month. And you can always go there under the heading of Safer Retirement Education and even download Brian's book on retirement, The Decker Approach. So again, 833-707-3030 to have a conversation with the team at Decker Retirement Planning. Brian, Mark, appreciate the time. Enjoy the rest of your weekend. Brian, we'll do it again next week.
Sounds good. Thanks, Mark.
Security and insurance services offered by Decker Retirement Planning, a registered investment advisor with the SEC. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual situation. Decker Retirement Planning is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein, provided by third parties, have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Decker Retirement Planning. This radio show is a paid placement.